Welcome back, guys. Today we are going to be speaking about unit trust investments compared to linked investments. A unit trust investment is an open-ended investment that allows you to invest in multiple asset classes, which is managed by a dedicated fund manager. The money that you invest is used to buy a number of shares or units in that fund. The more money that you invest, the more units or shares that you will own. Your value is calculated by multiplying your units by the unit price. In South Africa, there are many unit trust providers. Every provider will provide their in-house funds, which means that if you select to go with a particular company, you will only be able to invest in the funds that that company provides. If you want to invest into multiple funds, you will need to contribute the fund minimum, which is generally 500 Rand a month. So if you would like to invest into a balanced fund, you will have to contribute 500 Rand a month into the balanced fund. If you would also like to invest into a property fund, you would then need to invest an additional 500 Rand into the property fund, which means your total investment will be 1,000 Rand a month, but you will have a balanced fund and a property fund in your portfolio. Okay, so in a balanced fund, there is a nice spread of asset classes. So what this means is in the fund, there will be an allocation of local equities, which is slightly higher risk, but does offer a little bit more return. There's money market, which is pretty safe and steady returns, but a little bit lower than the equity. And then you look at offshore funds, property funds, which are very volatile and can offer high returns, but can also increase your risk of losing capital. With an unbalanced fund or a specific fund, you are investing your money into one sector, which means your investment is reliant on that sector as a whole. So if you're investing into a purely property fund, your money will move with the property market. If the property market increases, the fund will generally increase. If it decreases, the fund will generally follow suit. So in conclusion, a balanced fund spreads your risk and spreads your asset allocation. So it's diversifying your investments, reducing the risk, and looking to maximize returns. So it depends how much you're investing on a monthly basis, first of all. If you're investing the minimum, I would say look for a balanced fund. Something that has a nice spread of assets, so some into property, some equity, some offshore. A balanced fund for low investments is a good idea just because of the security and diversification. If you're investing a lot more money, then I would suggest having a balanced fund, having a property fund, having an equity fund, and then you as the investor can diversify your portfolio as well. The benefit of a unit trust is it gives investors with less money and expertise the opportunity to have a balanced portfolio and have it managed by a professional.